Assalamualaikum warahmatullahi wabarakatuh. So this is topic that you are going to learn today, which is recording transaction and events. We focus on receivable and payables. So this is part 1 of the receivable and payable. So this is the thing that you need to know about a receivable and payable. As you know that for trade account you have receivable, payable and credit facilities. And under this, what you are going to learn is receivable, accounting entries related receivable, age receivable analysis, credit limits, and then we proceed with the irrecoverable debts, indicator, debt written off, allowances, accounting entries, calculating the allowance for the full to bad, and summary. And the part 2 we are going to do this one, subsequent debt recovery, the full debt recovery and debts written off. And this under this video in this video also you need to know about the payable. That this only few things about payable, which is settlement and supplier statement. Let's start with receivable. We have two types of receivable, which is trade receivable and other receivable. So the trade receivable is related with the credit sales on goods or credit sales of goods or services. This is related with the customer who buy goods on credit from a business. So they are called trade receivable. And that is other receivable, which is not related with the trading. This is other income that company earn. For example, rent due to be received from tenant. This is amount that the tenant did not pay yet. We call that this rent receivable. The same as the tax that the government need to pay back. This is tax receivable or tax refund. And loan receivable, this is for a short-term loan that the person that make a loan with a business need to pay it. So we call that is loan receivable. Next, interest receivable related with the loan, interest that charged to the loan. So this is the interest that the company will earn from a person who made a loan from a business. So we call this one is interest receivable. And also advance payments to supplier. This is advance payment from supplier, deposit from the supplier. And this is amount due from group of company that you are going to learn later in semester 2. Okay, this is payable, same as receivable. The payable, we have trade payable, which is amount owed to trade supplier in respect of credit purchases of goods or services, which we call that this is accounts payable, trade accounts payable. And the other payable, same as receivable, but this one is the business owed to the landlord. We call this a rent payable. This is a tax that a business needs to pay to the government, so we call that tax payable. This is a loan or interest, and this also we call that loan payable, interest payable. Advance payment made from customer, so the customer give payment, but the goods and the service not delivered yet, so we call this as deferred income or unearned income. And amount due to group companies, this you are going to learn in semester 2. Salaries and wages earned by yet not yet paid to employees. So this is salary payable. And lastly, this is a dividend declared but not yet paid. We call that dividend payable. Okay, this is credit facilities that been offered by business. One is loan and overdraft. This is ordinary loans, and this is overdraft that offered for the current account, which the company do not have cash, but still can spend make expenses by using the current account. And this is lease, which is, for example, here premises or office. This is some sort of like loans, but the way is that a business will lease for the business, for example. So they will pay for the lease until the lease amount accumulate to the amount of the total premises. So when it already reached to the amount of premises, the title of premises will transfer to the business. This is hire purchase. Where the buyers agree to pay for goods, usually a car or equipment. So this also loan actually, but the payment is on installment method. And then buy now, pay later. This is usually a trading offered the sales of inventory by credit, and this is credit card. Okay, this is advantages of giving credit facilities. So the seller will increase revenue because by giving facility, so more customer will buy. So this will increase the revenue. Of course, they can obtain and use the purchase item immediately, minimize the need to carry cash or write checks, make expensive item affordable by allowing for them to be paid for a period. Buyer convenience, as the buyer does not have to be present at point of purchase, which is online shopping. And also by giving credit facilities, this will increase the customer loyalty, since the customer have a debt to the company, so they will come again to buy goods from the business. And about these advantages, of course, by giving the facility, there is tendency of the non-paying debt, and also will increase costs related to the collect of the debt, and also for the customer when buying things by credit, so there is tendency to pay late payment and penalties for the late payment of the debt, and administration costs to seller due to irrecoverable debt. And for the buyer, for the customer, if they want to use the credit facility, they need to secure a guarantee for the loan of the or for the credit facility given. As for the customer have given credit facility to customer, they need to control for the facility offered. So this is a two method that business use. One is age receivable analysis, which is analysis is usually a list ordered by name showing how much from each customer owes and how old their debts. The credit control function of a business use the analysis to keep track on outstanding debts and follow up any that are overdue. So this is also by receivable analysis. So the debt collection will be collected on time, and this will reduce the risk of the debt become irrecoverable debt. And then second method is the credit limit. So non-customer will use the credit facilities as much as they want. So they may use credit facility up to certain limit that a business offered. So the use of credit limits may reduce risk to business of a recoverable debt by limiting the amount sold on credit. So they cannot buy anything as they want, just limit to up the credit limit given, and help build up the trust of a new customer, be part of the credit control strategy of a business. Okay, when the business have given a credit facility to the customer, so there will be a irrecoverable debt. So this is an indicator of that that the debt is not being paid or become irrecoverable. So the indicator is that taking longer time to pay as usual. Okay, this customer start not to pay or pay let's say 1 month, then become 3 months to pay, and paying in installment outside normal credit term, as that the invoice said the payment is on 2 months, but maybe the customer will pay on 3 months. Regular disputing of invoice going to liquidation, so the customer become bankrupt. So if this happen, that should be written off. So when a business is owed money by a customer who is unable to pay, there is a little point keeping the customer account in the book, in the business book. If the debt is not an asset, then it should not be carried in the statement of financial position. To give a fair presentation in the account, irrecoverable debts are written out of the books and expense to profit or loss, thereby reducing the profit. So this is what happened when this business know that this customer is unable to pay, means that they won't receive the money, meaning that this customer or this account receivable is not an asset because no money is expected to come to the business. So when this receivable is not expected to pay, so this is not an asset, so it cannot be reported as asset in financial position. So it needs to be written off as this customer, this receivable be written off, it become expenses to the business, and it will reduce profit or increase loss. So this is a double entry related with the irrecoverable written off. So when a customer is identified as irrecoverable, so they will debit the irrecoverable debt expenses, the amount that been owed, and we take out the amount from the Trade Receivable account by crediting this account. Okay, when the business have given a credit facility to the customer, so there will be a irrecoverable debt. So this is an indicator of that that the debt is not being paid or become irrecoverable. So the indicator is that taking longer time to pay as usual. Okay, this customer start not to pay or pay, let's say 1 month, then become 3 months to pay, and paying in installment outside normal credit term, as that the invoice said, the payment is on 2 months, but maybe the customer will pay on 3 months. Regular disputing of invoice going to liquidation, so the customer become bankrupt. So if this happen, that should be written off. So when a business is owed money by a customer who is unable to pay, there is a little point keeping the customer account in the book, in the business book. If the debt is not an asset, then it should not be carried in the statement of financial position. To give a fair presentation in the account, irrecoverable debts are written out of the books and expensed to profit or loss, thereby reducing the profit. So this is what happened when this business know that this customer is unable to pay, means that they won't receive the money, meaning that this customer or this account receivable is not an asset because no money is expected to come to the business. So when this receivable is not expected to pay, so this is not an asset, so it cannot be reported as asset in financial position. So it needs to be written off as this customer, this receivable be written off, it become expenses to the business, and it will reduce profit or increase loss. So this is a double entry related with the irrecoverable written off. So when a customer is identified as irrecoverable, so they will debit the irrecoverable debt expenses, the amount that been owed, and we take out the amount from the trade receivable account by crediting this account. This example of the irrecoverable debt written off. So a business sells 500 of goods to Mr. Maxwell on credit. During the year, the debt is found to be irrecoverable debt. Since this receivable, which is who is Mr. Maxwell, is identified as irrecoverable, his account should be closed by crediting the trade receivable for Mr. Maxwell 500, and this amount should go to irrecoverable debt expenses. So we'll credit this account by 500. So at the end of accounting year, this amount should go to statement of profit or loss as expenses. So this will decrease the profit for the year. Okay, before that, we are talking about the irrecoverable debt written off. This is identified as irrecoverable. But some business, they also doing allowance for receivable. So allowance for receivable is the allowance that made on estimate amount for the amount of receivable. So this allowance for receivable is the amount estimated of the amount that the debtor are estimated not to be paid. So according to the prudence concept, business need to make this allowance for receivable because it is the business need to report for asset in statement of financial position, not overstate the amount. So by doing the allowance for receivable, so the amount of the receivable that they are able to collect is not as the whole debt. Maybe some of the debtor are not paying the debt. So this allowance for receivable are been recorded in or adjusted in the account. So this is for the purpose of a presentation in a statement of financial position that comply with the prudent concept. So this is how to extract. This is extract from the statement of financial position. How the trade receivable be reported in this statement. So this is a trade receivable. So the amount that were recorded for all debtors, and we need to do estimate less the allowance for receivable that been estimated before. So this is the net receivable that is going to be received by a business. So under allowance for receivable, bear in mind that the name for the receivable is still in the account. No crediting to the account by the irrecoverable yet. So this is just estimated amount that a customer are unable to pay for the business. But for the irrecoverable debt, return of this customer is being identified and able to pay the debt because of certain things. So accounting entries for allowance for receivable is for initial allowance is after doing the estimated, just the amount being debited to irrecoverable debt expenses and credit allowance for receivable. But there is, if the company has already a balance for receivable, balance for allowance for receivable, at the end of accounting year, the business made another estimation amount for the year, and the difference between the opening balance and the closing balance or the balance carried down, we will make adjustments based on this difference. Say, let's see if the balance carried down, which is the estimate at the end of the year, more than the opening balance, so the company will debit irrecoverable debt expenses and credit allowance for receivable. Whereas if the balance carried down is less than the opening balance, so they will debit, business will debit allowance for receivable and credit irrecoverable debt expenses. So we show here in this account, this is allowance for receivable. Let's say this balance carried down is more than the balance brought down. So there will be a short amount in this and credit side. So you just top up the amount being short. So the amount that the difference amount, you credit allowance for receivable, and then you will debit irrecoverable debt. This is if the balance carried down is more. But what happens if the balance carried down is less than opening balance? So at this side, at the debit side will be short amount with the credit side, balance amount. So allowance for receivable should be debited with the difference amount, and the irrecoverable debt should be credited for the difference amount. Okay, we look at for the example. So this is Aztec. So on 31st December 2013, Aztec made an allowance for irrecoverable debt of $100, and during the year, $50 of the trade receivable was written off as irrecoverable debt. So you need to do irrecoverable debt expenses and allowance for trade receivable by this situation. A situation if the allowance at the end of accounting year estimate as 180, and if it estimate by 80. Before that, you look at this question. There is a debt written off for that year. So this one you need to take out from the trade receivable expenses, $50. And then for calculation for the A, so we have at the end of the year, the estimated of the allowance is 180, and the opening balance is 100, so we have difference is 80. Since the closing is more, the credit balance carried down is more than the opening balance, so there is an increase to allowance for receivable. As a result, the difference will debit irrecoverable debt of $80 and credit allowance for receivable $80. So this is what I have told you, the account. So this is more, balance carried down is more, 180, and the previously 100. The difference is 80 because this part is not balance with 180. So 180 here we credit the allowance for receivable, and then we will debit for the allowance for receivable. The 50 here is the previously that the debt that been written off. So we just debit recover debt, credit trade receivable. Yeah. As for B, we can see here that the balance credit down is 80, which is less than the opening balance 100. So we can see that this part is short by 20. You just put this 20 to balance the T account here. So this is the different amount you debit allowance for receivable, and for irrecoverable debt you credit for $20. So at the end of accounting year, what go to the statement of profit or loss is not 180. This is incorrect. This is 50, 30. This should be 30, not 130. It should go to the statement of profit or loss is 30. Whereas for this one, so the amount that should go to statement of profit or loss is 130. For this one is 30, which is 50 minus 20. Now let's go further with this question. This is account receivable. We have 4 account receivable: Joe, Jandis, Esther, and Walls. The total amount of receivable is 16,000. So at the end of the year, a general allowance of 2% against the remaining account balances is considered to be necessary. So, but the Joe is disputed her balance, means that since this Joe is dispute to pay the balance, so Joe become the specific allowance for receivable. So as for the solution, you see that since Joe is dispute to pay his allowance but not become irrecoverable yet, we just put as specific allowance for Joe 1,000. As for the general allowance 2%, we just calculate the amount of total receivable here minus that the specific allowance that have been made, which is 100. Minus this, we will get the total allowance that need to be estimate for 2% is 15,000 multiplied with 2%. So the general allowance for receivable is 30. So the allowance for receivable for that year is 1,300. So this is a count. This allowance for that year, the first year. So you just credit allowance for receivable 1,300 and debit irrecoverable debt 1,300. So this will carry forward for next year 1,300. As for irrecoverable debt, this go to statement of profit loss 1,300 to reduce the profit for that year. So this is for the allowance. As for allowance, we have 2 types. In calculating allowance, one is specific allowance, another one is general allowance. So specific allowance means against amount due from a specific customer. This is for example that I just told you. So the Joe, we have know that the Joe is tendency not to pay for the debt. So we make it as specific allowance, the whole amount or in part. Okay, the customer account receivable is kept intact. So we look at this one. We will look at whether Joe pay or not. For general allowance or further allowance, usually calculated as percentage. This one, 2% here. This is the general allowance that means the balance of the specific balance after taking out the specific allowance made against account balances other than those against the specific allowance has been made. So I just I have already give example before with this example. So Joe is the specific allowance and the rest is the general allowance. So how to calculate? You just look at here. I have told you before. Okay, this is a presentation of the statement of financial position as for previous for the Joe. So after we made the estimate for allowance for receivable, which is 1,300. So what we are going to report in the statement of financial position is not 16,000 for the trade receivable. We just report as 14,700, which is we will less 1,300 allowance to the 16,000. Now let's go to year 2. For example, previous example. And this example, Joe settled her dispute invoice. Hester has paid in full, so this is the rest of account receivable, which is Jandi's 4,000 and Wool's 4,000. So the whole amount for account receivable is 8,000. So at the end of accounting year, 1,000 is to be allowed against the account of Jandi's, and 2% general allowance is still considered necessary, which is for the Wool's. So the calculation for this one, you can see that Jandi's is considered as the specific allowance. So the specific allowance is only part of that is 1,000. So we just write down specific allowance for Jandi's 1,000. So as for the whole Wool's, we only take general allowance of 2% only. So multiply with 400. So 80 is estimated can be collected from this. So the total allowance for that year is 1,800. So as for the allowance for receivable account, previously we have 1,300. So this year's for the second year, the estimated is 1,800, which is less than the opening balance. So at debit side, we can see that the short amount of 220. So you will debit this amount for allowance for receivable, and we credit the irrecoverable debt as 220. So at the end of accounting year, so the statement of profit or loss is 220. You will credit of statement of profit or loss. So this is considered as income to the company. So we do not put as the income. What we just put in the statement of profit loss under expenses, we just write under irrecoverable debt. If the amount is expenses, meaning positive amount, we just put as positive amount. If the amount is more in credit side, so it will give the balance of credit balance. So you just put irrecoverable debt in the statement of profit or loss under expenses as credit balance when you're presenting a statement of profit or loss. So this is part 1 for the receivable and payable. So please do exercise that I've given to you. So I will let you know which number that you need to do. And we will meet again with another video for the part 2 of receivable and payable. Okay, that's all for this video. Thank you.